Yes, Reserve Bank of India has announced draft norms for ECL framework. Remember, currently we are on incurred credit loss approach, and now the banks will move from incurred loss approach to expected credit loss approach, meaning not only what is happening right now, you have to see the future as well in simple terms. Now, what are these norms? Remember, the governor had earlier indicated that there will be sufficient time given to banks for implementation, and hence a glide path has been given from 1st of April 2027 to FY31. Now what will change? It will be first of all applicable to all the banks, but having said that, there is an exception for RRBs, SFBs as well as payment banks. The rule does not apply to them, and the draft norms suggest that 40 bips provisioning is required for stage 1 loans, which is what the current approach is as well. However, where the changes are there for SME and farm loans, and that will have a lower stage 1 provisioning floor at 25 basis point. The norms also suggest that unsecured retail loans will attract higher stage 1 provisions, and that will start from 1%, and stage 2 assets will carry out prudential floor of 5%, and that is for most of the products it is applicable. Now for home loans, LAP, gold loans, for lower stage 2 provisions, that will be around 1.5%, and that has been suggested in the norms. Now the banks will be allowed to add additional adjustment amount to CET1 capital to offset this impact, and therefore that should help banks. Now the question arises, what happens on stage 3 loans? Stage 3 prudential floors range from 10% to 100% based on the aging of the NPA, how old the NPA is, and unsecured retail now faces 25% provisioning of NPA up to 1 year, and 100% will be after 1 year. So all in all, the whole account will have to be provided for the bank, and Reserve Bank of India has clearly mentioned that accounts which are upgraded from stage 3 to stage 2 must have at least 6 months before they are being upgraded to stage 1. All in all, what we have understood through banks, the interactions we had, that there will be limited impact for banks, but yes, we are moving to a different approach of expected credit loss provisioning.